So what gives us this confidence that there is still a decent scope for interest rates to go down? So in September we had the FOMC meeting. What we saw in the FOMC meeting was one, the Fed board mark to market their employment forecast. As we can see, from 4% projected in June, they are now projecting a 4.4% unemployment rate in the fourth quarter of 2024. From a 4.2% projection, they are now projecting 4.4%, and from 4.1% in June, they are projecting now a 4.3% unemployment for fourth quarter of 2026. If we look at their real GDP forecast, that's largely unchanged, apart from a very modest decline in 2024. So from a 2.1% forecast, now they're projecting a 2%, but the rest of it is unchanged. But if you look at the core inflation as well, now they're projecting in a 0.2% decline in 2024 and a 0.1% decline in 2025. So it's almost reaching close to 2% target. But the more important thing which we have to look is the Fed fund target which they have given in 2024 and 25. So compared to 5.1, which barely implied a 50 basis rate cut, now they're projecting a 4.4% by end of 2024, which largely implies a 100 basis rate cut during 2024. And if you look at 2025, they are projecting about 3.4. So again, almost 100 basis cut, in 2025 as well. So yes, they started the rate cut cycle with a 50 basis, but if we look at the dot plot, it suggests a gradual path of rate cuts going forward. The Fed, although they started with 50 basis, but they were slightly circumspect and tentative. Chairman Powell called it largely a insurance rate cut, as the economy is slowing. Unemployment is rising, although the last print was quite strong. But broadly, they started that given the distance that they have to cover. So if you look at how much of rate cuts they're expecting almost a 200 basis rate cuts in next 2 years. So if they have to do a 200 basis rate cuts incrementally, they thought that they can start with 50 and then they can look at data as it comes along to decide on incremental course of action. More importantly, they don't still view the economy as very weak. So Fed chair characterized labor markets in solid shape with a very healthy unemployment rate and conditions close to maximum employment. So if you just like we said, if you look at their forecast on real GDP, that's not changed materially. So they're still looking growth at quite reasonably high, and hence we believe that they will be more gradual in their rate cutting cycle. Although they have started with 50, unless and until the data sharply deteriorates, we think that they will be cutting in the sequence of 25 basis.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.